So talk to me a little bit about crypto. I think crypto's dumb, and I think the main use case of crypto is criminality. What do you think?
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.
What is up, everybody? I am Jason Trost, the host of the Business of Betting podcast. Today, I'm joined with Steven Salz, the CEO and founder of Rivalry, Canadian-based sports betting companies. Thanks for joining us, Steven.
Yeah, thanks for having me.
Cool. So you're Canadian, eh?
That's right.
So Canada's been in the news a lot lately. You got a prime minister who went down. We have an incumbent president, not incumbent president, what's it called? President-elect who wants to subsume your country. How are you feeling as a Canadian? And then I guess you also have like a housing crisis going on. How are you feeling as a Canadian these days?
That'll be all right. Maybe we can become the next U.S. state. I think there'd be a lot of people that might be okay with that. Yeah, I don't know. It kind of feels like a failed experiment up here in a number of ways. So I'm not totally surprised to see where things are going right now. Anyone who spent a little bit of time in what we consider healthcare or the housing market or the job market is having similar experiences the last few years. So I think this was an inevitable outcome.
As somebody that's from the lower 48 states, what I would like Canada, when we were kids, it kind of always seemed like the sort of the grown up, nicer, safer version of America. Now it kind of seems like basket case is probably too strong of a word, but like, what's the short answer of what's happened in Canada? Is it as bad as it seems right now?
The joke I always thought ours occurred was being Canadian is like living in the attic of the crack house, and the crack house being like the U.S. obviously, and maybe we've like huffed too many of the fumes, and now we're turning into kind of the crack addicts or something. But yeah, I think it's similar to what people are seeing. Yeah, the housing market is completely unaffordable and impossible. You see people posting bills of their groceries online saying, "Hey, I bought this carton of eggs and a few apples, and I just spent $40." The exchange rate between the U.S. and Canadian dollar is the worst in over 20 years, which is usually a good indicator of just general economic health. And yeah, a lot of the things that we were kind of lauded for, like free healthcare and stuff like this, if you experience it in the last few years, it's not like it used to be. When I grew up, that healthcare was very good. Now, I was telling something the other day, I had to go to the hospital for something a year and a half ago. I was quite literally fighting off like homeless people and crack addicts, waiting for 6 to 8 hours in a waiting room. Eventually got to a bed. It was like a World War II era cot. It felt like nurses and people yelling at each other, lights flickering. So it's not the dream, the utopia that it, I think, used to be pitched as.
So my understanding was that Canada, like many Western nations, was experiencing population decline, and rightfully so. Canadians decided to be proactive about that and increase the amount of legal immigration, which they did very strongly, up to 1 million a year or something like that, which is like 5% of the population, which is maybe is too much. And that all this new immigration is causing cultural issues, housing issues, and stretching the system. Is that kind of like the right way to think about what's going on right now?
Yeah, I think that's accurate. Like my grandparents' generation, who were all immigrants into Canada, it was a different working culture, different place they came from, different era, very hard knocks. All they wanted to do was come and make a living for themselves and work and contribute to the country because they were so thankful. Like my specific grandparents were escaping World War II and Jewish background, so running away from the Holocaust and things like that. And they were very thankful to be here and worked until, they physically couldn't anymore every single day and helped to drive and build the economy of what it is today. You get the same story of like Irish immigrants and all this kind of stuff, and it's consistent. And it's very different now. Now you get a group of people that are looking to maximally kind of game and optimize the friendliness of the system here. And in many ways, that's been kind of one of definitely the key inputs to its downfall.
Is there a path out of it, or is it going to be pain for the next 10 years? What's the path out of it?
It'll be pain probably for the next couple of years for sure. Even Trudeau a few months ago kind of admitted defeat or that it was a mistake in terms of the immigration policy. So that's clearly going to change. And yeah, I think, I went to, there's a few things that happened in the last like 16 months, but one of the ones that Canada wanted the headlines for, I'm not sure if you saw this on Twitter, if you're chronically online like I am, but was the capital gains tax for like unrealized gains, or just capital gains tax generally in Canada, that got all the entrepreneurs speaking up and saying there was no reason to start a company or build a company here, because if you exit, you'll get, taxed so heavily. There's no kind of asymmetric reward for building businesses and doing something entrepreneurial here. So Toby from Shopify, who kind of leads like the vanguard of like Canadian, there's like Elon of Canada in a way, in terms of like being outspoken but still kind of Canadian about it. He put together an event I went to for kind of Toronto-based Canadian entrepreneurs to be like, what the hell are we going to do about this type thing? And one of the lines he used was, Canada's like go for bronze culture, which I thought just explained everything. And it's typical, like, I mean, during the Olympics, like that's the huge difference between like Americans and Canadians. I think what the mindset it's going to take for us to win is during the Olympics, like if Canadians get, when we win a bronze medal, like everyone cheers and is so happy and is thrilled. Americans are different. It's like if it's not gold, it's like, go home.
If you're not first, you're last, in the words of Ricky Bobby.
Yeah. It is not. That is not the case here, right? Where it's very much a culture of, it's like a participation trophy culture. And it's, bronze is awesome. And, that's great. We did our best. So I think that was kind of the tone of the conversation as well. I think everyone there felt that needs to change. And then like the analogy I've used, and you have to have read the book, I guess, is it's like Atlas Shrugged in slow motion here. That's what it's felt like the last like 10 years. It's like an Ayn Randian kind of experiment, but gone the exact inverse of what she wants.
What was the issue with the capital gains tax? I didn't see that headline. They wanted to tax unrealized gains?
No, it wasn't unrealized. Like I messed up, but they were changing they were significantly increasing capital gains tax on, I think it was just a significant increase in the capital gains tax, which already is quite high. It's like, 50% we say right now. Yeah, I can get to 50%. Yeah.
Wow.
And the way the math worked out is it was basically another 20 to 30% increase. So it was something like, if you had a $50 million exit in Canada, you would net maybe something like 60 to 70% less than you would building the exact same business in the US, for example. Like, It was that dramatic of a difference. So yeah, there's been a massive export of talent. Most entrepreneurs, including at this kind of event I went to, like, there's absolutely no reason to build a company here. So if you're born and raised in Canada and you feel you have absolutely no reason to start a business here, and you, for every multiple reasons, you would go south of the border or elsewhere, that's not really a great environment that's been created here.
Yeah, it's a shame because, even though I'm very American, I'm very pro-American, I don't want America to be the only strong country in the world. I think America needs other strong, it needs a strong Europe, it needs a strong Canada, it needs a strong Mexico. And so it's too bad to see Canada struggling like that. So, Steven, why are you in Canada?
Born and raised here. Wow.
Yeah, are you stuck for sentimental reasons, or have you considered transplanting the business?
I've considered it. I think we were talking before, Starlink, I have a family here, and then my whole family's here. So your brother, sister, their kids, and then once you have little kids, and then you're in kind of that ecosystem of having family around, and daycare, school, etc., it becomes harder and harder. You become really kind of stuck. I don't want to totally lament and say everything about Canada's bad. It's not. I think part of what motivates and inspires me and other people to try to make it better is it has lots of great things about it and can be like an absolutely incredible place. So yes, for raising a family still, it is very safe. So like that is good. Public school system is perfectly fine. The overall support system for having a family is still good and better than you would find in most places. So yeah, it's nice to know you're in a safe neighborhood and safe environment, which when you have kids ends up being weighs quite heavy, obviously, in the calculation.
Yeah, I have young kids myself, and I've done near grandparents and far away from grandparents, and by and large, it's way better being near grandparents than being far from grandparents. Yeah. I had a similar situation in 2016, the UK, I founded Smarkets in London because sports betting was illegal for the longest time in the States, as everybody on this podcast probably knows already. Then they voted for Brexit in 2016, and I was so pissed. And to be honest, I'm still pissed about it. And I was like, fuck this. I'm not basing my business here anymore. So I went and opened an office in Los Angeles, and I thought, I've started an office before. I'm just going to replicate what I did in London over in California. And I really underestimated all the different nuances and changes and culture and building an office from scratch. And it ended up being a lot harder than I anticipated. I kind of thought I would be able to do it with my eyes closed. And the office that we've ended up shutting the office, I mean, some of that was because of COVID and situations like that. But I never could quite click a secondary office in the United States. Americans get paid way more than they get paid in in the UK, for example. That was a huge shock to me, even though I'm American. My business grew up in London, so I'm kind of used to the London rates. Americans like for like get paid, I would say 50 to 80% more. At least engineers are getting paid 50 to 80% more. I don't know what it's like in Toronto, but that was a culture shock. You know, we were in LA, so I thought we would kind of get Google, Facebook dust, magic fairy dust, but you know, there's such a gap between what they pay and what everybody else can pay. It was a lot tougher.
We had the same experience in Toronto when we first started. I remember whenever like our investors would ask me like, what's the most challenging part about building or scaling the business in the early years? It was always engineering talent and trying to compete against. I mean, at the time it was also like Shopify and all these other companies in Canada. But even, I remember Snapchat was opening an office. Uber was huge here and had a big office. It was the same thing. The gap was gigantic. There was more demand than supply. This was like that whole kind of COVID popping that bubble and all the layoffs that were happening in all those larger companies, which then I think really helped normalize the market. But at that time, it was impossible, basically.
Yeah. So one of the things I noticed about your company, which I'm fascinated to talk about, is you did a direct listing. That's something that I've wanted to do for years and years. Can you set that up for the audience about what happened, and then let's talk about it?
Yeah. I'm not sure how it's more like capital market securities law corps that we worked with to deliver specific objectives for us. I'm not sure how exciting it will be, but I can give like a quick summary, which is in Canada, for people who are familiar with Canadian capital markets, which can be a little silly compared to the US one sometimes in terms of the dynamics, I would say. And people, large American investors think it's kind of like a banana republic here in terms of like the relative quality at times or the approaches. But what often happens in Canadian capital markets is companies go public through, especially smaller companies, through what's called a reverse takeover, an RTO. So you just have groups of investors will create all these random shell companies and list them. The shell company does absolutely nothing and needs some minimum number of investors and capital, and you can list a company on the TSX Venture.
It's like a SPAC.
It's like a SPAC. It's like a tiny like mini SPAC. Yeah, it's exactly that. So it's like a mini SPAC. But it doesn't even have to really do a qualifying transaction for a long time. It can kind of just sit there. But investors just create these and then just sell them to other people to reverse their company into to go public and kind of hack going public, because you can do an RTO in like, I don't know, 2 months. You can have a large private company and then all of a sudden you're a public company in 60 days. So it's designed for much kind of deeper, darker, mafia-esque kind of capital markets hackery that I can go on for a long time. I used to work in Canadian capital markets on the investment banking side, so I know the whole like clown car. But we didn't want to do that because often companies that are RTO, there's a negative perception of quality, which makes sense because most companies that are RTO are just like basically pump and dump schemes often, to be honest. We don't want to be associated with that because we've worked hard to build a quality company that we really cared about. And the IPO process is challenging because you have to we still did a full prospectus, I'll get into that, but the difference is the sequencing when you raise capital. So we knew we were going to go public at some point in 2021. Yeah, some point in 2021, which was, that was like peak kind of GameStop meme stock market. This wasn't because we were prophetic in some way, thinking, oh, this market's going to crash at some point toward the end of 2021. But there was a huge amount of appetite in the capital markets for gambling sector generally in early 2021. So we were kind of stuck between a rock and a hard place. We're like, okay, we don't want the low quality view of an RTO that would allow us to move quick and jump on this capital now. We don't want to do an IPO because the problem with the IPO is you legally can't go market to raise capital until you have the full prospectus signed off and approved on by securities regulators. And then you can do a roadshow legally. But that's like 7 months of the distance. This was the beginning of 2021, and we're like, all the money's here now. So the direct listing was like the perfect in between, where it still had a full kind of high quality listing in terms of the perception. We still have to do a full prospectus, but through a structure called a sub-receipt, we were able to raise the money basically right away without any prospectus, without anything. And then from the point at which the money closed, within our term sheet, we said, okay, within 4 months, we'll have a fully approved prospectus and we'll go public. And then at that point, we would list, and then, money's ours basically. But it allowed us to raise the money when there was appetite, not do an RTO to look crappy, still do a full prospectus to have the complete kind of transparency and quality of basically an IPO, but not get stuck with risking having to do all that work, all the legal, all the brain damage, only to get to the roadshow, and then maybe the capital markets fall out from beneath us. And we're like, well, shit, we just wasted like 6-7 months doing this. So that was the strategy with that one.
I'm fascinated about it. So I guess, is it Rivalry.corp? Is that your...
Rivalry Corp is like the corp name, but Rivalry is the brand name, yeah.
Okay, and what does CVE stand for?
Oh, the Canadian Venture Exchange.
And how many exchanges are there in Canada?
There's really only 3 major ones people talk about, which is the TSX, which is the big board, the main one, yeah. And then there's, which has certain criteria, sizing, liquidity, assets, etc. Then you have the TSX Venture, which is like, I don't know, Russell 2000 equivalent. And then you have the CS, I think it's the Vancouver Exchange, basically. It's like the CSX or something like that. CSE, I think it's called. CSE. That one is like OTCQX equivalent. That is the one where all the
penny stocks are.
schemes are played. Yeah.
Sure.
Which is a very like gentle way of saying what happens there.
I got a logging company in British Columbia for you to buy.
Yeah.
And so CVE, is that like run by TSX? Is that kind of
Yeah,
like
yeah, it's TSX.
Okay.
Yeah, it is like the TSX venture. Yeah, yeah.
Okay. And so I did a little bit of research. I'm by no means an expert in the US capital markets, but I did a little bit of research to direct list in New York Stock Exchange or NASDAQ. And I think they said you had to have like 200 or 300, maybe 400 or 500. You had to have a couple hundred private shareholders, and there were a few other requirements. And then you had to work with I don't know what the right way to call it is, like a market maker to make sure that you can price it. Did you have to go through both those processes?
Similar. Yeah, we needed, I think, minimum of 200 investors. We needed to have, there's a minimum amount of, like shares outstanding, all these different like liquidity measures, all this kind of stuff flowed. Yeah.
So you're a young company. I mean, I think, we've done many rounds of financing, and I think we have only 150 shareholders on our cap table. How do you have over 200 shareholders?
Because the RTO process, you do need something similar. You need, I think, 200 shareholders also.
Right.
I will say that Canadian capital markets, which here is like Bay Street, which is our version of Wall Street, has a very robust machine at just filling a cap table with 200 shareholders, which really just means you go to a couple of retail brokers who have a bunch of clients who like to play these deals, and then the minimum investment is tiny. I think it's like $1,000 or $100 even. So so there's a couple of retail brokers. They're like, hey, I got 500 clients, and I'll just drop 200 on your cap table for, you give me a little bit on the side. Like, this is where it gets kind of gross. We didn't have to do that, but it was more, we did work with a couple of investment banks who just helped us get up to the minimum level of shareholders for the listing. And it's a pretty straightforward thing, to be honest.
Okay, I had lunch with a Goldman Sachs person one time, and we were talking about, I think Spotify did a direct listing. And, like the traditional IPO process is obscene, the way bankers make money. And they quote unquote underwrite it, and they take all the risk, and, they charge you like, 7% to like take no risk.
Except buried in the engagement letter is they have no liability or risk or anything, and they kind of write it off to you.
It's insane, but they they have the gall to call themselves underwriters. Anyway, I think Spotify, I don't know what you want to call it. It's sort of it's like a cartel, and you kind of have to pay, what's the right word? It's another mafia term. It's like extortion. It's like an extortion racket. You pretty much have to do an extortion racket to pay the bankers to go live. And so Spotify ended up having to pay, even though that they did this mechanism, which is in theory much smoother and more elegant, they still had to pay the extortion racket. And from memory, I could be off by a little bit, but I think Spotify had to still pay $60 million for a direct listing to the cartel that runs this mechanism. So Spotify had to pay $60 million, give or take, to run this extortion racket. What did it cost you, give or take, did you have to get a bank? Did it have to be tier one? Did the tier one banks not want to deal with you because nobody likes direct listings?
It wasn't that bad because we were a much smaller company. I guess relative, it felt painful, but between legal fees, and I think we paid maybe like 6% or 7% on all the capital raised, because we did bring in capital through this like subscription structure. We raised 20 million US or something like that. So between like the fees beyond that, legal, venture listing fees, etc., it wasn't crazy. I mean, I think it was like $1 million, $1.2 million. But for us, relative to the size of the company, relative to capital raise compared to like Spotify, I remember at the time I was still, shaking my fist at the sky and not really feeling too happy about it, and didn't feel like these people did anything. So it was super frustrating.
So you still have to pay the piper.
Oh yeah.
Yeah. I like startup idea number 345 I have is like to redo the system, to create a new stock exchange, make it easy to IPO or direct list, like get rid of these fees are insane and the friction. I don't understand, like you used to be an investment banker. I don't know. Did you work on the capital markets or did you do other stuff?
No, I worked in capital markets. Like I was a research analyst that covered equities. I did a lot of SPAC stuff actually, so was very familiar with that before it started blowing out a bit more.
I used to be a trader, and as far as I can tell, all these companies are slow to IPO because they're worried about the valuation. When the valuation shakes out in 6 months anyway, like who cares? Like I don't understand why all these companies like Stripe and all these famous tech companies are sitting on the spotlight. Some of it I think is like the expense and the annoyance of going through the whole process. But
yeah, it's a lot of noise being public. I mean, it adds load to my schedule and like mental capacity that I didn't really have. But I do think it also is good. It forces a certain level of honesty and transparency on the company. They can't like hide from anything. So I think that's positive. Obviously, the negative, which I've talked about elsewhere, is like, and I'm sure like you're off first, you would know, is you get judged on the merits of 3-month cycles because your quarterly reports are everything, which is 90 days. And anyone who's ever built a business knows 90 days is absolutely nothing. It can go away in the blink of an eye. And you can have something totally innocuous within that 90 days that in no way indicates the health of your company over a longer term view, but then it gets extrapolated by investors as, the sky is falling. And like, that is an incredibly frustrating thing to deal with. So that's the worst part about it. Nobody takes a long term view, not even remotely. So you do have to, playing within that meta it can constrain decision making in a highly negative way, in my opinion. So you have to be super careful about that. That's the worst part.
So I'm looking at your stock right now. Am I reading this correctly? Your market cap's 17 million, give or take?
Yeah.
So do you have requirements to give guidance? Is that required? Or
No.
What are your listing requirements?
We quarterly reports within specific time frames that we're obligated to do. Little stuff like, have an IR site and all these random little things.
Oh, you have to have an IR site even at this. Yeah. And I assume, do you have any analyst coverage, or are you too small for analyst coverage?
We have one. We used to have two. So the investment bank that took us public, we got some coverage from them right after the listing. And then after about 2 years, they ended up dropping coverage, which is also somewhat typical, like part of the model, which understandable because I used to be in that job myself. But yeah, I mean, like the company, if you look at the stock, you pull it out, you can see the company went public at like 120 million valuation. So it's come down quite significantly over the last.
This is fascinating to me. This is like so interesting. So one of the things that I've often been frustrated with, and maybe you don't have the market cap to kind of support this model. How many people work at your company?
80. We had 140 6 months ago. So yeah.
Well, same. We're 90 now. And one of the things I've been jealous of, the big listed companies, they can do the RSUs. It's a very nice, convenient way to compensate everybody. Are you using RSUs because you're publicly listed, or do you do traditional options like most private tech companies?
This is a Canadian quirk, I'm pretty sure. I'm 90% sure. This is another reason why people don't like building businesses here. So RSUs, we give all our staff options, because if we gave them an RSU at the cost basis for it, even though the employee doesn't pay for it, so like our stock is, let's say 20 cents. If I give someone $5,000 worth of RSUs at 20 cents, that's just shares that they have. They could go sell them or do whatever they want with it. If it's at 20 cents, they probably won't, because that's the cost basis for it. But it instantly gets taxed as income. So all of a sudden, I gave someone a gift of $5,000 at 20 cent share stock.
Even if it's at the money?
Yes, they have to know, like, once they've received it, now it gets taxed as income. We gave, what instead we've done is we gave people options. So we did the best we could, which is we give everyone options. We've repriced it a few times because, as you can see, the stock has come down. So we want everyone to be aligned at kind of the different levels we're at. We have a system, I think it's like through Morgan Stanley and ShareWorks or something like this, where we made it possible to do cashless exercises, which is basically the best option. So they get options, let's say 20 cents, let's say stock goes to $1. So there's, let's say 80 cents of profit. Then rather than them having to pony up the cash themselves to then go buy the shares, exercise the options, then go sell the stock, which the process of that can be kind of annoying depending on which jurisdiction you're in. With this kind of service we've been using, it took us like a year to find the right one and get it all set up. It's just cashless. They just sell. They basically are almost like lending some of the options to this provider, who then goes and exercises, sells them. That covers the cost of the exercise, and you just keep the difference basically. And then at that point, you're still getting tax, capital gains, whatever it may be, but you're in the money and you're profitable, rather than here's a bunch of RSUs and you're also going to get taxed on it, which would be shitty, because we gave some staff, we dealt with this around the IPO where then the stock went down. So you can imagine, like, you get a bunch of RSUs, you get taxed on it, and then stock goes down and you're screwed now. And potentially what you sell for can't even cover what you paid for it.
So I guess to summarize, like, after going through this, it looks like you've done this for like 3 or 4 years now. Like, would you recommend this, or do you think you're mad and you wish you hadn't done it?
No, I think like it's the inputs we had at the time that led us to the decision to go public within that moment in time, with all the information we had in the context of the business. It was the right decision then, based on where we're at now and what we know now, and what's also happened to the market, because we basically top ticked the GameStop meme stock market in 2021. We went public in October 2021. It was already cooked and kind of sealed, so that was done. And then early 2022, you get the Silicon Valley Bank explosion. You get rates going completely upside down, which then, because you worked in finance, like the finance 101 is rates go up and then liquidity gets sucked out of small caps. It only goes up to mega cap super liquids, goes to fixed income. And then the average daily volume on the TSX Venture in 2022 dropped over 8. Like this is Rivalry. This is the whole exchange. The average daily volume, weighted average daily volume on the TSX Venture in 2022 was 85% lower than the prior year. 85% on the entire exchange. Think about that. That's just been a brutal experience as a result of like the market context we went into. So yeah, knowing what I know now, probably wouldn't have at the time with the information we had at the time. Within like that, snapshot, it was correct.
Do you know who market makes your stock? Like, is there?
You have to hire one. So there's a few. Yeah. So we use one called Generation ICAP. That's just one company, but yeah, they
pay them something to kind of maintain a bid offer spread. Interesting. Oh my God, I hope the listeners found this interesting, but I'm like, this is really cool to geek out on this stuff.
With a liquid stocks, it's hard though. Like, you were a trader. Like, try to market make a stock where our stock will trade, average daily volume like 5 to 10,000 shares at 20 cents, which is nothing from like, trying to market make that.
Yeah, it's hard. Yeah. When I was a trader, one of his main algorithms was try to fuck the bots that are market making these like micro caps, because a lot of it doesn't pay to have a human doing these things, and there's some kind of bot that goes up and down, and
it's just like, I'm using language you'll probably know. It's all like iceberg, so it's like it's like an iceberg thing, and then it looks like a little, but there's a lot sitting behind it, or it just ladders down, half a penny at a time, but there's really nothing there. It's all like kind of bullshit trades. Yeah.
So as a public CEO, I assume you have restrictions on what you're allowed to say. I guess it has to be rooted in fact, unless you're talking about the future, then you can say whatever you want. Is that?
As long as I qualify with a disclaimer, it's usually fine. I can't give guidance that I would otherwise have to put a press release on, but you could probably tell I speak relatively candidly, and sometimes I get in trouble.
All right. So public CEO, why should I buy your stock? How would you answer that as a public CEO?
We've completely transformed the business in the last 6 to 8 months. I mean, the main priority for the company right now is we believe obviously we're on the cusp of getting to profitability, which is all that really matters in the markets the last 2 years. We've made all the very hard and difficult decisions to do that. So that's one. I think that'll be an important and material catalyst for the company, where we can support ourselves, not be relying on external capital, which just changes, I think, re-rates the company, re-rates the multiple. Number two, we've, from a player KPI perspective, we gave these numbers in our last quarterly report as part of the evolution of the business to get to profitability, cut costs. Yeah, we basically doubled our margins over the last 12 months. Our player ARPU, which is really important metric. We've significantly leaned in on how do we build kind of a more scalable player acquisition model to generate higher ARPU, so a fewer number of players can drive more growth for the company. So we gave in our last quarter, we've essentially doubled the player ARPU in the last 6 months as compared to its 3-year trailing history up until that point, which is, as again, somebody who runs a consumer product, I think getting ARPU to go up is difficult. 5 to 10% is great. Yeah, we've essentially doubled it. So we've shown that we have an ability to drive individual player value, cut costs to get to profitability, and then those two things combined allow us also to return to growth. So I think being a growthy company that's profitable in a sector like this is super positive. And then we've got a couple other catalysts on the crypto side, which we can either get into or not, but we've been leaning really heavily into crypto. Company has its own token. This gets a little more nuanced, but the token, which is a very, very fancy loyalty program, this will be going live at some point, likely in the first quarter, which is also guidance that we've given, and that will be somewhat of a material catalyst for the company, both almost like a mini liquidity event for ourselves and also for our user base and another driver of player acquisition. So
how would you describe your business? It's sort of like a vanilla sports book aimed at younger people. Is that a BDC sports book? How would you describe it?
Yeah, it's just a full, complete online casino sports book, but definitely aimed at more like internet generation, internet culture. Because when we first started it, we were very focused on eSports, because that was the thing we knew really well. So we did eSports betting, like sportsbook, eSports betting. We had traditional sports in that we started to add a full casino suite. So if you go to Rivalry right now, it's a complete product. But definitely, the 80% of our users are 80 to 90% of our active users, and even historically acquired users are between the ages of kind of mid to late 20s to early 30s. That's been our sweet spot.
They have no money, Steven.
Yeah, they're definitely smaller spenders, for sure. Yeah, so I think that's kind of part of the challenge I'd let it right is, and a lot of the changes we made in the last 6 to 8 months and been very public about it, is the volume of individual players that we needed to get to profitability with age player base was actually proving itself to be scalable. There was return on invested capital there, but because the market was completely unsupportive of it, and therefore we had no access to capital to keep funding that specific type of model, which did have a crossing over point to profitability, but it was going to require more capital. Yeah, we had to significantly adjust the model. That's kind of why we started leaning more into the crypto side. Our player base did mature. Like, the average age has gone up versus if you were talking to me 2 years ago, I would have told your average players in their early to mid 20s, which would have required a lot of them. to hit a critical mass.
So did you build your own tech, or are you using a white label?
No, we built our own tech from scratch.
Matching engine, all that kind of stuff is all
that was kind of maybe a mistake in some ways. My background was capital markets, but maybe more consumer side. My other co-founders were
how hard could it be?
Software, exactly. Yeah, they were software devs, but had never built in the gaming space, but built lots of other consumer products, and also just like how hard could it be? And when we first launched, like kind of soft launched in late 2018, I will say also the white labels weren't very good. They were not nearly as robust as they are now, but we did not fully appreciate what it took to drive customer success and on a product like this. So yeah, we literally built the entire thing from scratch. We built our own CRM system, our own back office, everything. Like
good to giving me a call.
Yeah, it was crazy at the time. It was, I think it delayed the potential outcome and growth of the business by 2 years. 24 months. Just we learned a lot. That is now paying dividends, but like painful.
I think it delayed us 10 years. Like it took us 10 years to build a full suite sports betting stack. So talk to me a little bit about crypto. I think crypto's dumb, and I think the main use case of crypto is criminality. What do you think?
Yeah, I think anyone who understands the ability to kind of monitor transactions in the space and source of funds and trace wallets and whatever it may be, if you're a gambling business, the propensity for fiat money to come from a list of places and your ability to determine that within the technical constraints and controls you have of just like, I don't know, like a wire transfer or just a typical PSP fiat deposit is, in my opinion, worth your ability to determine if the source of a crypto deposit is illicit. So because, you have no idea how the cash got into somebody's bank account. Like here, the main deposit for Ontario in the regulated market is Interact e-transfer, which is like, I don't know, it's like Cash App. It's just like a Venmo kind of thing. And we have someone e-transferring money out of their bank account. You have no idea how the source of the cash that came into it, but because it's a classic fiat method, it feels safe and comfortable to regulators. Whereas the ability to trace a crypto wallet and the source of the original transactions to know something is dirty or not, actually as good or greater. So from like the criminality perspective, there's really no, in my perspective, any material issues there. The reason why we really lean into it and why I think gambling has been such a big source of volume for crypto, because it just is a big category for crypto, is it's effectively the ultimate payment service provider for gambling. And also like Rivalry, like we have an idle man license, meaning in Ontario, meaning we operate in gray markets, so-called some offshore markets. Anyone who's ever worked in that part of the industry, which obviously is many people, knows that the movement of money and setting up fiat payment providers is like the bane of your existence. It's brutal. It's unbelievably challenging. Crypto essentially is like the perfect PSP. It has no downtime. It has no middleman. You don't pay the fees. Like you're not getting rinsed by PSP fees. It's instantaneous, in and out. It literally never goes down. It's way better for the player because if you're a player of an online gambling site, you want your money to hit instantly, and when you hit withdrawal, you want it instantly back in your bank account. So I think the reason why it's been taken up so heavily by gambling is there for sure is a kind of grosser side of completely unregulated, no KYC, crypto-only casinos that can get really gross. Operators like us that do it within like effectively a regulated framework that crypto solves all the problems of traditional PSPs, which is why I think it has just become so successful in online gambling, which is mostly why we started to adopt it. And then you can imagine that the demo that I gave you, this like 28 plus demo, the overlap of that person and their propensity to hold crypto and utilize it and have a wallet with money in it is higher than also an older demographic. So it just fit really neatly for us.
Say more about how you can trace a transaction, because I know you have the blockchain and you can kind of look at, you can go back in the chains, but the previous transactions, you don't necessarily know who the counterparty was, what it was for, right?
You have tools like chain analysis, for example, where you can go back as far to like the original, like the origination of where that specific $50, $100 came from. And there is different tools that they have where they can determine, like, did that come out of a wallet that was transacting on websites or places that look pretty gross or sketchy? Or, hey, was this an originally created wallet 5 seconds ago that just received a ton of money from this other wallet? Looks kind of weird. And then they took that money and then instantly deposited on your website. Because there's a lot of crypto gambling sites. I'm not 100% sure how we do this, but a lot of other crypto gambling websites, for example, if you log in or create an account with your crypto wallet, which you can, so like MetaMask or Phantom or whatever it is, if you literally just created that wallet, like you just minted a new wallet that has no history, no transactions, no nothing, it often does not allow you to deposit or do anything with it because like they usually want wallets with history that they can then look at the history, see where everything came from. But I mean, it's the same thing. Like I could go deal drugs to you right now and you give me $20 of cash. I walk to an ATM, I go deposit $20, then I have $20 in my bank account. I go Interact e-transfer it and start playing on a regulated Ontario website. Nobody would have any idea about that either.
Well, I don't know what it's like the law is in Canada. I'm pretty sure the law in the UK is that the bank is responsible for knowing the source of funds if they deposit cash. So in theory, like if somebody has a Lloyd's account and they deposit money, even though you're correct, you don't know where that money from Lloyd's came from. Lloyd's technically has a responsibility. Now, the government doesn't let you lean on Lloyd's having clean money to say, well, this came from Lloyd's. They have clean money, therefore we have clean money. So the flaw in the system is they expect every hop in the chain to do their own checks, which is it's insane.
Real money, fiat transactions. We're not.
I completely agree with you, by the way, that almost everything is better from a money movement perspective. But the frustrating part of that is that has nothing to do with the dollar. That has to do with the regulation around the dollar or the regulation around the financial industries and money movement and stuff like that. So like, it's not a limitation of digital fiat. It's a limitation of the governments regulating these things.
Yeah, I mean, in a way, definitely it is like regulatory arbitrage a little bit for sure.
Yeah. And I mean, that's sort of why I call crypto is the main benefit of crypto is the legality, because it lets you go around these laws that were created, some good faith, some bad faith, but it lets you go around all these rules. Of course, it's going to be easier. You know, if I had a digital currency that didn't have to follow the rules of the U.S. government, and dollars, like it'd be just as good. Awesome. Well, I've really enjoyed this conversation. Before I let you go, what do you want to be when you grow up?
I'm still trying to figure that out. I'm sure we all are. We were talking before that. You and I both follow that seems or sounds like different veins of curiosity, and the thing we do is not, our only interest. So, I ask myself that question often. Look up into the sky and ask, who am I? So I'm still figuring that one out.
What does the sky answer back? Does the sky answer?
Oh yeah, I'm not really sure if the divine is there or not. I'm working on that one too. Yeah.
Okay. All right. Well, thanks for stopping by, and thanks for geeking out with me on capital markets and direct listings. I hope the audience loved it, but I personally loved it very much.
Yeah.
Good luck with everything.
Thanks.
Bye.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.